Okay, so in this video, this will be the fourth video, what I want to look at is something we're going to come to really, really love, and that is the basic accounting. I'm abbreviating. The basic accounting equation. What is the basic accounting equation? It is that assets equals liabilities plus owner's equity. There it is. Assets equals liabilities plus owner's equity. Now, what are assets? Assets. Assets are the resources. Assets are resources that a company owns or controls. They're resources that a company owns or controls. Liabilities are claims against those resources by creditors. Owner's equity. Owner's equity is what's left over. It's claims that the owner has on the resources after subtracting creditor claims. Now you might be looking at this and you're probably going, what in the world are you talking about? Oops. Sorry about that. I'll give you a good example of this. Let's say, to make this very practical, let's say you're going to buy a house. And here's a picture of the house, how you're financing the house. Let's say the house is $150,000. $150,000 is the house, and you put down $15,000 as a down payment. You put down 15%. You put down $15,000 as down payment. You go to the bank and you borrow $135,000, and that's what you borrow from the bank. Okay. Now, let's take this simple example and plug it into our accounting equation. Okay? Get a different color pen so it can be really fancy. Assets equals liabilities plus owner's equity. If we were to prepare a balance sheet for you, say, hey, what do you have for, based on this example right here, your assets are what? They are $150,000. You own or control an asset valued at $150,000. And that's equal to liabilities. You don't own the whole thing. You borrowed $135,000. So $135,000 is what you borrowed from the bank, plus you put down $15,000. So 150 equals 135 plus 15. The assets you control, the resources that you own or control, are valued at $150,000. That's the cost. You borrowed, you have creditor claims to First National Bank of Traverse City, let's say. You now have $135,000 that you owe them as a liability, and you own owner's equity. What's left over after is $15,000. Hopefully this makes sense. It helps to clarify the accounting equation. Assets equals liabilities plus owner's equity. Owner's equity is going to be changing as a result of the operations of a business or an entity. As we sell sneakers, as we make money from the selling of sneakers in our sneaker selling business, as we sell sneakers and make money, the extra money that we make, or the money that we make over and above our costs, goes to increase our owner's equity. We're going to look at this in greater detail, but I just wanted to start off with the basic accounting equation. Assets equals liabilities plus owner's equity. Give an example and see how this example would translate into that accounting equation right there. See you in the next video.